So now you have a bit of background on what supply and demand trading is and how the zones form, it's time to talk about the two types of zone. As you know, supply and demand zones come in two variations: supply zones, points where price will reverse and begin falling, and demand zones, points where price will reverse and begin rising. However, these zones fall under one of two types based on how and where they form in the market. Each type has its own characteristics which influences how price reacts to the zone and ultimately reverses. In this video, I'm going to detail what these two types are and what the key differences are between them. Let's look at the two types first. On the face of it, supply and demand zones all look and form the same way. Price rises or falls after previously moving in the opposite direction. That's how all zones form. However, while the process for how supply and demand zones form is always the same, where that process takes place in the market isn't always the same. For example, take a look at this supply zone. See how it formed during the downswing, signalling a continuation? Price moved lower, paused, then continued falling, creating a new supply zone. The zone formed after price had already fallen. Now compare that with this demand zone. This zone formed at the beginning of a new upswing. It didn't form from a continuation like the other zone, it created an entirely new swing. Price, which was falling, reversed and began rising, forming a demand zone. See the difference? It might not seem like much, but this difference in where the zones form at the start of a swing versus when it's already underway plays a huge role in what price will do when it returns. This is where we get the two types of zone from. We have rally-based rally and drop-based drop zones. These only form during a swing. And we have drop-based rally and rally-based drop zones, which only form at the start of new swings. Okay, let's look at the two types in more detail. So first, we have rally-based drop and drop-based rally zones, or RBD DBR zones for short. These are the classic supply and demand zones, the zones everyone thinks of when they hear about supply and demand trading. They form when price reverses after moving in the opposite direction and are the rarest, though still very common, of the two types. Rally-based drop zones are the supply zone variant. These form when price, which has been rising, that's the rally, bases for a while, basically pauses or just reverses without any sort of pause, and starts falling, creating a new significant downswing. The resulting zone is a rally-based drop supply zone, because that's how it formed, from a rally base followed by a drop. Drop-based rally zones are the opposite. These are the demand zone variant. These zones form due to the same process, but the other way around. Price falls, that's the drop, bases, again either pauses or simply reverses, and then rises, setting off a new significant upswing. That process creates a demand zone known as a drop-based rally zone. Let's switch over and look at the other type of zone now. Rally-based rally and drop-based drop zones, RBR DBD for short, are the most common type of supply and demand zone. These only form during an upswing or downswing, usually towards the midpoint but not always, and continue the current swing rather than ending it, like we see with rally-based drop and drop-based rally zones. Here's what a rally-based rally zone looks like. These are always demand zones, by the way. Rally-based rally zones form when price rises, bases, again either pauses or retraces slightly, before rising again, continuing the current upswing. Now notice the zone forms after the swing is already underway. It doesn't start a new swing like a rally-based drop zone does, it continues the current swing. This is an important distinction and has a big effect on how the zone performs, which I'll explain in the next section. Let's look at a drop-based drop zone now. Here then, we have a drop-based drop zone. Again, the zone forms during the swing, towards the end in this case. Drop-based drop zones always form when price, which has been falling, bases or retraces slightly for a while before falling again, creating a supply zone. On average, rally-based rally and drop-based drop zones are weaker than their rally-based drop, drop-based rally counterparts. Many of you might disagree, especially if you trade supply and demand already, but it is true and something you must be aware of. The problem with rally-based rally and drop-based drop zones is they only form during a swing, signalling continuation of that swing rather than a reversal, unlike rally-based drop and drop-based rally zones, which always set off a new swing. As I said earlier, supply and demand zones form due to the banks entering positions, i.e. taking profits, closing trades or placing trades. Every zone, no matter where or when it forms, is created due to one of those actions. The banks place their positions, the zone forms. Price returns later on so they can get their remaining positions executed. Now, what determines what size positions the banks can place is how many other traders were buying or selling at that time in the market. If lots of traders were buying, the banks were able to sell a large amount. If lots of traders were selling, the banks were able to buy a large amount. So, because rally-based rally and drop-based drop zones always form during a swing, i.e. after price has already risen or fallen, the banks can't buy or sell as much, because most traders are now trading in the direction of the swing due to the rise or fall. For example, Being a rally-based rally zone, this demand forms after price has already risen. So most traders are now buying, meaning the banks can't buy that much. Not enough traders are selling. It's like going to the market to buy 100 hats to sell for a profit at a later date, but only 30 hats are being sold. You can't buy as many hats now, not enough are being sold, so you can't make as big a profit later on. You haven't got the stock. That's what's happening here with the banks. It's exactly the same. Since the banks can't buy as much due to the low number of sellers, that results in a weaker zone forming. The banks aren't interested in making price reverse from a point where they've only purchased a tiny amount. It wouldn't be worth the effort. That results in a weaker zone. The banks can't buy or sell as much. Therefore, they're not that interested in making price reverse when it returns. Now, with rally-based drop and drop-based rally zones, it's the other way around. These zones only form when a new swing begins, so before they form, price is always moving in the opposite direction. Like this zone, for example. Before this zone formed, price was falling heavily, so most traders were selling. That meant the banks could buy a large amount. There were tons of sellers ready. This is like going to the market and being able to buy more than 100 hats because so many are being sold. You can make an even bigger profit selling them later on now because you can buy more. This is why rally-based drop and drop-based rally zones are stronger than rally-based rally and drop-based drop zones. They form due to the banks buying or selling a much larger amount. The banks would only buy or sell a huge amount if they were confident price was going to move in their expected direction. So the chances of price reversing from a rally-based drop or drop-based rally zone is much higher because the banks will either want to defend their positions or buy or sell more to get any leftover positions placed. Let's look at the other difference now. Following on from the above, being weaker, rally-based rally and drop-based drop zones tend to generate smaller reversals and reactions than a rally-based drop and drop-based rally counterpart. Again, this is because of how the zones form. The banks don't buy or sell in large quantity to create rally-based rally and drop-based drop zones. They can't because there aren't enough opposing buyers or sellers available. So they can't place large positions, like trades, to create rally-based rally and drop-based drop zones. They enter some small positions, that's why price continues rising or falling, but these are tiny, nothing compared to the huge positions they placed at rally-based drop or drop-based rally zones, where they have masses of opposing buyers or sellers at their disposal, ready to transact with them. So there's no incentive to make price reverse at rally-based rally or drop-based drop zones. The banks don't care. If price breaks a rally-based rally or drop-based drop zone, it's not a big deal for them, because they haven't bought or sold a large amount. And usually the banks close their rally-based rally and drop-based drop positions before price returns. They use them more as scaling in entries, so they close them before price reverses. That way they profit from each before entering a big position at a rally-based drop or drop-based rally zone. What this all means is rally-based rally and drop-based drop zones will usually generate smaller reversals and reactions than rally-based drop and drop-based rally zones. You can see this in the example below. During this segment of price action, the rally-based rally and drop-based drop zones all cause minor reversals, pauses or retracements. The drop-based rally zone, on the other hand, initiates the end of the downswing itself, resulting in a major reversal. Why did price reverse in such a big way here? Because that's where the banks bought the largest amount. Thousands of traders were selling before that zone formed, allowing the banks to buy a huge amount to cause the rise. So, when price returns to the zone, what do the banks do? They buy again to enter any leftover positions or to protect their initial positions. As a result, price reverses and we see a new upswing develop. Now with the rally-based rally and drop-based drop zones, that wasn't the case. These didn't form from the banks buying or selling a large amount, so the reaction they generate is much smaller. The banks aren't interested. They use them more as points to take profits, not to enter major trades like rally-based drop or drop-based rally zones when they have masses of buyers or sellers available. If you were watching this unfold before you then, you'd have the drop-based rally zone marked as the main zone, the zone price will most likely reverse at. The other zones would all be points to watch for small retracements, pauses or consolidations because you know they haven't formed due to the banks entering large positions. Now, does that mean you'll never see big reversals or reactions from rally-based rally or drop-based drop zones? No, of course not. You still need to watch them closely for entry signals. You just need to be aware that whatever reversal they cause is likely to be small and short-lived, so it's better to keep your profit target small and your stops close. So to close this off, there are two types of supply and demand zones. Rally-based rally and drop-based drop zones, these only form during a swing, and rally-based drop and drop-based rally zones, these only form at swing points, when price either swings down after swinging higher or swings higher after swinging down for a while. These are the highest probability zones because the banks can buy or sell more to cause them to form due to price moving in the opposite direction before they form, giving the banks many buyers or sellers to transact with. Now, let's move on to section 2 and I'll show you how to trade supply and demand zones.